Welcome back, everyone. Thank you so much for joining me. The United States dollar just had its worst 6-month start to a year since 1973. Due to extreme volatility, there may be some ups and downs. You're going to see some ups and downs, but it is the trend that you need to look at, and that downward trend is clear and it is undeniable. As global investors move their funds away from US dollar denominated assets, we need to have a conversation about what is driving this acceleration in the global loss of confidence in the US dollar and what it means for US consumers. In the first half of 2025, the dollar lost over 10% of its value against a basket of major currencies. That's not just a market dip, that is a warning siren, if you will, from the global financial system. And the question on everyone's mind is, what is happening to the dollar and can it recover? Will it recover? To understand this, we have to look beyond the headlines and into the foundations of global finance and economic framework that is built on a certain acceptable level of trust in the stability of the United States. For decades, the United States dollar has been the bedrock of the global economy. It's been the world's safe haven where investors flee during crisis, where central banks park their reserves, and where commodities, of course, from oil to wheat are priced. But this year, something changed. Investors began to run from the dollar, not toward it. So what triggered this exodus? It all started on April the 2nd, a day President Trump triumphantly called Liberation Day. That's when his administration imposed sweeping new tariffs on imports from almost every major trade partner of the United States of America, triggering immediate sell-offs in U.S. financial markets. And so as a result, in just 3 days, more than $5 trillion was wiped from S&P 500. U.S. treasuries were dumped, yields spiked, debt costs surged, and with that, confidence in the United States economy cracked. As we know very well, Trump paused some of the tariffs. A week later, he did, but the damage had already been done. You can't just undo it. You can't pretend it never happened, because foreign actors notice these things, and of course, they react to them. International investors had seen enough, and so this erratic trade policies, the escalating debt, and the undermining of the Federal Reserve's independence were all flashing red lights, and they still do. And then, of course, came the next hit, Trump's One Big Beautiful Bill. Billed as an extension of his 2017 tax cuts, the legislation promises deep reductions in healthcare and welfare spending, along with a huge expansion in borrowing and a huge expansion in military budget. The nonpartisan Congressional Budget Office warned that once it is passed, which it has now, the bill would add $3.3 trillion to U.S. debt by 2035. That would push the national debt to GDP ratio far beyond its already record high of 124%. Similar to US debt to GDP ratio during World War II, by the way. So markets panicked again. And as the dollar stumbled, other assets surged. Gold hit its all-time high as central banks hedged against dollar devaluation. Investors snapped up German and French bonds, and the euro climbed to $1.17, gaining over 13% in just a couple of months. Even American investors began looking abroad. European stocks have risen 15% in local currency terms since January of this year. And thanks to the weaker dollar, that translates to a 23% return in dollar terms. Can you believe that? So what's unfolding isn't just a sell-off, it is a loss of faith in America's ability to manage its own economic future. Nobody thinks that the United States can do that anymore. For decades, the dollar's dominance was taken for granted. The US accounts for roughly 25% of global GDP, but over 60% of global bank deposits, 70% of international bonds, and 57% of central bank reserves are held in dollars. That is not just financial power, that is geopolitical leverage. But Trump's America has shaken the pillars of that trust, its institutions, its legal predictability, its central bank independence. Even Moody's took notice of it, stripping the United States of its top credit rating this May for the first time in over a century. So, what does a weaker dollar mean? In some ways, it might actually help the United States temporarily. A cheaper dollar makes American exports more affordable and it reduces trade deficits. But tariffs are distorting those benefits. I will repeat that again. Tariffs are distorting those benefits, making imports more expensive and raising prices at home. And for everyday Americans, the consequences are already being felt. Food, electronics, travel, all pricier, all impacted by a dollar worth less abroad. But globally, the picture is more complex. For developing nations holding dollar debt, countries like Zambia or Ghana or Pakistan, a weaker dollar offers some relief. It is in their favor. Their repayment costs actually fall when dollar weakens, and that is a good thing for now. Commodity exporters, too, are cheering. Oil, metals, and agricultural goods priced in dollars become more expensive, which of course boosts revenues for countries like Nigeria, Indonesia, and Chile. But underneath all this, something more profound is shifting. It is the perception of safety. The perception of safety. Investors are beginning to realize that they are overexposed to US assets, and that realization could change the global economy in ways that we haven't seen since the 1970s, which I covered in a recent video in great detail. Foreigners hold about $19 trillion in US stocks, $7 trillion in US treasuries, and another $5 trillion in corporate bonds. If that pullback continues, which it is poised to continue, even modestly, it could trigger a feedback loop of higher US borrowing costs, slower growth, and further dollar declines. The Federal Reserve, meanwhile, is under immense pressure to cut rates again, with future markets pricing in up to 3 cuts by the end of this year. Trump has been pushing very, very hard, as you know very well, for looser monetary policy, even as it risks fueling the very inflation that had just begun to retreat. So where does this leave us? For now, the dollar remains the world's reserve currency. It is. There's no alternative, be it the euro, the renminbi, or even crypto. But reserve status is not a birthright. Let's remember that. It is earned, and it can be lost. If the United States keeps undermining the institutions and policies that have made the dollar the cornerstone of global finance, that cornerstone will continue to crack. And if that happens, the next 6 months may actually make the first half of 2025 look just like maybe a beginning, just as a pregame. The dollar isn't just falling, it is being re-evaluated by investors, by central banks, and by the world. And once trust is lost, it is very, very difficult to get it back. Now, show your support if you enjoyed this video, like, subscribe, and share. It really helps me. Support my work on Substack and Patreon. You will find them linked in the description below. I hope you enjoy the rest of your day, and I will see you back here tomorrow. Bye for now.